So I've got a money question for you, and there's a 1 in 3 chance that you don't know the answer. Are you ready? What is your credit score? There's a study done with Yahoo Finance that 31% of Americans, or almost 1 in 3, do not know what their credit score is. And if you're the one in those 1 in 3 people, don't worry about it. You're obviously not alone. Just sit back, relax, or skip around at the bottom, and let's find out what your credit score is together. If you're new to the channel, my name's Stuart, and I'm here to help walk you through the confusing and unfair world of finances and credit in general. So back to the question of what is your credit score? Well, your credit score is a 3-digit number that rates how trustworthy or reliable you are to lend money to in the eyes of banks and lenders. The range of credit scores is between 300 and 850, and they're broken down in this manner. 800 to 850 is excellent, 740 to 799 is great, 670 to 739 is good, 580 to 669 is fair, and everything else 300 to 579 is poor. Now, no matter where you are in this range, it's okay. We all make mistakes. We're going to climb this credit score ladder together. Maybe you've checked your credit score in the past, or maybe you went to get a car and were surprised by what your credit score was, and you might be a little too afraid to check it again. Because in the back of your mind, you know, maybe it's not what it should be, and you're not ready to confront that yet. Well, let me put your mind at ease a little bit and know that 21 million Americans have absolutely no credit history with any national credit reporting agencies. So even if your credit score in the low 600s or even 500s or lower, that's okay, because you already have a leg up on 21 million adults. And that number might surprise you, but if we look in our last video, we saw that almost 30 million Americans have a debit card, but they don't actually have a credit card. And that there's many myths surrounding credit cards leading to that number. But moving back to your credit score, it's composed of 5 different factors. Payment history, which is 35%, utilization, which is 30%, length of credit history or average account age, which is 15%, new credit or number of hard inquiries, which is 10%, and credit mix, which is also 10%. But really, the only 2 that you need to worry about getting started is your payment history and utilization. Your payment history references the number of on-time payments that you've made to a line of credit. This is the most important factor to keep track of and make sure that you stay on top of. Out of all the 5, this is the most important, because one little slip up with your on-time payments can tank your credit score. So every month, it's very, very important to make at least the minimum payment on your credit card or a loan. Now, you should always pay your credit card off in full every month, but if something happens, if there's an emergency and you're tight on cash, please, please, please still pay the minimum monthly payment. Your payment history is broken down into 5 ratings. 100% is excellent, 99% is great, 98% is good, 97% is fair, and less than 97% is poor. So let's look at an example of why just missing 1 payment can tank your credit score. So I have a credit card and I've had it for 11 months, and every month I've paid it on time. So I have 11 out of 11 months of on-time payment history. Then in the 12th month, I forget to pay my credit card balance. Missing that 1 payment will drop my on-time percentage down to 92%, or in the poor range. You know, okay, it was a hectic month, I forgot to pay a bill or 2, that happens, but it's going to now take you 2 years to get back up above just 97%, back in the fair rating. And then it's going to take you 7.5 years to get just to great again. And then it's going to take you 188 months to get to excellent, or back up to 100%. Now, after hearing that, you might be going, oh my God, what do I do? But typically, on-time payment percentage is part of the long haul of credit scores. There's not a lot you can do to speed it up, Because every month, if you just have one credit card, then you just have one opportunity to make an on-time payment. But if you got another line of credit, then you'd have two opportunities to make an on-time payment. And then that would cut the time to get back to 100% down in half. But a little disclaimer here, if it was financially irresponsible actions that got you here, like by overspending, then I would recommend not opening up another account until you can get back on a financially responsible track. However, if this was just a very hectic month and you forgot to pay a bill, maybe there's a little more wiggle room for that. This is why I always recommend turning autopay on for your credit cards. And you can set autopay to just do the minimum monthly payment. The second biggest factor is utilization. And so utilization is how much of your total credit limit that you're using at a time. Your total credit limit is the total amount of credit that you're allowed across all of your credit cards. And we need to keep this under 30% as a general rule of thumb. So in an example, if I have credit card A that has a $1,000 credit limit and credit card B that has a $2,000 credit limit, my total credit limit is $3,000. If I have 10 credit cards and they all have a $1,000 limit, then my total credit limit is $10,000. So as you go through your credit journey and get more and more credit cards, your overall credit limit can skyrocket. For instance, I have over a $200,000 credit limit across all of my cards, and my utilization is usually around 5 to 10%. Now there's never going to be an instance where I'm going to spend $200,000 and use all of that, but by having such a high limit, I can make a very large purchase, say $20,000 on one of my cards, and then my utilization is only going to be 10%. Whereas if I had a $20,000 limit and I make that same $20,000 purchase, then my utilization would be 100%. One very important thing to know with utilization and how it affects your credit score is that in the current FICO model of scoring credit, utilization has no memory. So in that last example, if I had 100% credit card utilization, my score would plummet. I'd probably lose, upwards of 100 points on my credit score. And you'd see that and I'm sure your heart would stop. But once I fully pay that off and my utilization drops from 100 to 0, then in a month or maybe 2, it might take 2 to recover, my score should rebound right back to where it started. The key thing with utilization and improving your credit score is that this is what you have the most immediate control over, and it's what you can use to fix your score the quickest. Moving on to length of credit history. This is the average age across all of your credit accounts, and it's broken down in this way. Excellent is 9 years or more, average age. Good is 7 to 8. Fair is 5 to 6. And needs work is 0 to 4, according to Credit Karma. Now, in my opinion, this piece of your credit score isn't something that I ever worry about, and it's not something that you should stress over, because if you're first starting off in your credit journey, then you're going to have little to no history, so your average age is always going to be very low. Let's look at an example. If I only have one card for 5 years, my average credit age would be 5 years. But if I opened a new card or got a new loan at that 5 years, then my average age would only be 2.5 years. That's because I have a 5-year account and a 0-year account, and that averages to 2.5 years. However, if I open 2 cards or 2 accounts at the same time and keep them open for 5 years, and then at the end of 5 years I decide to get another account or card, then I would now have an average credit age of 7 years, because that's 5, 5, and 0 years of age divided by 3 average out to 6.7, almost 7 years. The second to last factor is hard inquiries. When you apply for a new line of credit, the banks have to run your credit or do a credit check. And so what this does is it pulls your score from one of the credit reporting agencies, and it also lets those agencies know that someone's checking your credit, because this adds what's called an inquiry on your credit report. Now there are soft inquiries and hard inquiries, but for the sake of this video, let's pretend that all inquiries are hard inquiries. A large amount of inquiries added to your account at a time doesn't look very good in the eyes of banks. However, this is tracked differently for auto loans and home loans. So let's look at an example. If I wanted a credit card and I apply for one, I get denied. Then I apply for another one, and I get it. I now have 2 inquiries on my report. However, if I want to finance a car, I am allowed to go and shop around for different car loans. As long as they're within 14 days of each inquiry, they get lumped into just one. You do not have to use financing provided by the car dealership. They're there to make as much money off you as possible, and they're already doing that with the markup of cars. So it's usually best not to go with financing at a car dealership unless there's a special offer that's going on. So before I go and buy a car, check a bunch of different banks and see what my rates would be with each of them. So this allows you to get the best deal possible without an adverse effect on your credit. Home loans are the same way. Instead of a 14-day window, you get 45 days. The last factor to go over is credit mix. Lenders like to see a healthy mix of credit because it shows that you can successfully manage lots of different credit. There's revolving credit, which is credit cards, retail store cards, or gas station cards. And there's also installment credit, which is mortgages, auto loans, and student loans. Both of these types of credit should be represented on your credit report, but it's not the end of the world if they're not. I don't really worry about this too much. It definitely should not be a focus of trying to build credit. It's not worth going and getting an auto loan or getting a personal loan and paying all that interest just for the sake of building your credit. Credit mix is something that comes naturally along your credit journey. All right, we got through the informational part of the video. Now let's answer some questions. So after all that, you're probably thinking, well, how do I check my credit score? Well, a lot of banks allow you to check your credit score for free right in their app or on their website. So I would recommend logging into your bank and then scrolling or searching for FICO credit check, credit score check, something like that. Odds are it'll be on the overview page or somewhere along the side. There's also the option to use the app Credit Karma. Credit Karma is a free app. They're not sponsoring this video or anything, but they're what I use to check my credit score. You don't need to check it every day. You can check it if you want to monitor your progress, but really you should only check your credit score once a month or if you're thinking about doing any sort of financing in the future. Another question would be, how often does my score change? Well, your score changes every time the bank responsible for your line of credit reports it to a credit reporting agency. So that's usually about once a month after your statement closes. So if you have multiple lines of credit, it's likely that they're not all going to report on the same day, and your score will change multiple times a month. And lastly, why does my credit score even matter? In today's world, your credit score is used to determine just about every major financial move that you make. Trying to rent a new place? Credit check. Trying to finance a car? Credit check. Trying to buy a house? Credit check. And your credit score will determine whether or not you get the loan. It'll also determine the interest rate associated with that loan. Banks make their money off of the interest they charge you on their loan. If you look like an irresponsible lender, your interest rate is going to be higher because they expect you to not be responsible or not make the payment every month, and then they make more interest off of you. Let's take that and apply it to auto loans. So if we look here at this graph of interest rates for new cars and used cars broken down by your credit score, we'll see that people with excellent credit or super prime borrowers have an interest rate that's almost 3 times smaller than those with bad credit. And this could save you thousands of dollars by having a good credit score. And this goes even farther whenever we apply it to home loans. A good credit score could knock off 0.5% to 2% of interest off your mortgage loan. This may not sound like a lot, but let's look at this example. So I'm an excellent borrower with an 800 credit score, and I want to buy a $300,000 home. The interest rate that I get is 7.3% on a 30-year mortgage, and my monthly payment would be $2,320. At the end of this loan, I'll have paid $441,000 in interest. That's crazy. That's more than the price of my house that I'm just paying in interest. Now let's look at a borrower with a good credit score. The interest rate on that same $300,000 home is now 7.8%. which is only 0.5% more. But each month, it's going to cost me over $100 more in my monthly payment. And at the end of the term of the loan, I'll have paid over $37,000 more in interest at just 0.5%. Lastly, let's look at someone with fair credit. The same loan for that $300,000 home now has a 9.15% interest rate. And my monthly payment is just under $400 more at $2,710 a month. At the end of that loan, I'll have paid $581,000 in interest. That's $140,000 more than the excellent credit score borrower at not even a 2% difference in the interest rate. So if you ever needed more of a push to get your credit in check, if you ever want to buy a house, it could save you hundreds of thousands of dollars. Okay, that was a lot of information, so let's go over everything one more time. Your credit score is a numerical value between 300 and 850 that's assigned to you as a borrower and shows how much the banks can trust you with their money. It's impacted most by missing a payment, and that's also the hardest thing to recover from. But don't worry, if you can't pay it off in full, which you should every month, as long as you make the minimum payment on your credit line, it counts as you making an on-time payment. I highly recommend using AAoPay and setting it to the statement balance so that way you don't have to worry about missing a payment. If you're too uncomfortable with doing that, you can also set the AAoPay to just the minimum payment. So at the very least, if you can't pay it off in full, at least you know that you're not going to ruin your on-time percentage. Utilization is the second biggest factor, but it's also the factor that can be resolved quickest. Your score can change multiple times a month, depending on how often banks report your information to the credit reporting agencies. Lastly, your score is used to determine if you're going to get a loan and then what the interest rate of that loan is going to be. A lower interest rate, even by 0.5%, can save you tens of thousands of dollars, and an interest rate difference of 2% can save you hundreds of thousands of dollars. All right, there's everything you need to know about your credit score to get started. I hope after this video you feel a little bit more comfortable with checking your credit score and getting it back on track. I'm going to have a lot more videos about how to improve your credit score and how to make responsible decisions with credit. So if that's something that you're interested in, please consider subscribing so we can go on this journey together. If you like this video, please give it a thumbs up below. If I missed anything or you have any questions that you want me to answer, leave a comment down below and I'll be down there to answer any questions that you have. All right, that's it for this video and I'll see you in the next one. Thanks.